Hello, everyone, and welcome to this special time for our weekly webinar, where today I'm going to be talking to you about the 4 steps of trading consistency. These 4 steps you can apply to virtually any trading method you have. It doesn't matter if it's one of my strategies or one of yours or someone else's. You can apply them to any time frame, and I really feel they will increase your odds for consistency tremendously. For example, let me share with you what I'm going to be showing with you today. Let's take a look at this chart in Adobe. Now, someone looking at this would say, well, Steve, it's easy to see we're in a downtrend, right? We made a high there, and now we broke that most recent low, and now we're making lower highs. So we're in a downtrend. Well, with one of the steps I'll be sharing with you today, you would have known that you were not in a downtrend. You were actually in an uptrend. Therefore, you would have been a buyer. And another step I would have been sharing with you would have told you where to place your stop. And then ultimately, you would have known where to exit, which would be at this point right here. And potentially you could have captured, just by using these 4 steps, 22.5 points. So this is going to be the subject of today's educational presentation. We're going to be talking about the 4 steps to trading consistency that you can apply to any market and any time frame. And everything you're seeing today is displayed coming from our platform, the PTS Primo Charting platform. I developed this with proprietary strategies that actually teaches traders how to trade. So welcome once again. My name is Stephen Primo. I am the president and founder of Specialist Trading. I've been trading now for 48 years. I started my career on the floor of the Pacific Stock Exchange, where I was on the floor for 16 years, and 9 of those years I was a specialist. That's where we get the name Specialist Trading. Specialist is someone who made markets in roughly about 50 or 60 stocks. So I made markets during the crash of '87 and the bull market that followed. I left the floor in the mid-90s to manage money and to trade my own account. And about 15 years ago, I teamed up with ProTrader Strategies with one goal in mind, and that was simply to educate traders. And I'm happy to say we have students around the world in over 115 countries and in virtually every state in the United States. And that's what we do. That's our main goal, is simply to educate traders. We're not here to tell you what we think the market's going to do tomorrow, or what the best stock is to buy or sell, or what time frame you should be trading. Those are all things we teach you so that you can find out for yourself. So as an educational company, our goal is simply to teach you how to trade. And you'll see that in today's educational class. Now, before we begin, we're required to share this with you, so please take a moment to view our disclaimer. I'm going to share with you a number of performance results using these 4 steps, but please remember that we can in no way guarantee that any of the results I'm about to share with you will be repeated in the future. And since we are first and foremost an educational company, all examples are strictly for educational purposes only. Now, if you haven't done so already, please feel free to follow us on X, formerly known as Twitter. There's our handle right there. You may want to copy that down. Every day I post between 5 or 7 different snapshots of signals our methods have generated, also little bits of financial wisdom. So you can get more free education on a daily basis by following us on X. Also, if you're watching this right now on YouTube, please hit the subscribe button. That way we'll ensure having a lot more content for you and a lot more ways to get education on a daily basis, either by X or by subscribing to us on YouTube. Okay, with that stated, let's begin today's educational presentation. I'd like to start out with something that my mentors taught me, and they said, Steve, trading is really simple. It's the trader who makes it more difficult than it has to be. I mean, think about that. When I think of my own trading, when I first started trading nearly 5 decades ago, I had roughly 20 or 30 indicators on my screen. I had about 2 or 3 screens actually in front of me. I was trading multiple markets at a time, just overcomplicating things by following too many gurus and mentors. You know, we didn't have chat rooms or trading rooms then, but we had subscriptions and newsletters. My trading was so complicated. It's a wonder why I couldn't make any money my first year or two. So when I started to really strip away what my mentors called useless noise and just relied on things that were consistent and kept things very simple, that's when I started to become more and more consistent. So as you see right here, trading is really simple. It's the trader who makes it more difficult than it has to be. And let me share with you what I mean here. So in order to be consistent, you must always apply these 4 steps. It makes no difference what market, makes no difference what time frame, makes no difference what strategy you're using. But if you apply these 4 steps, I truly believe you will increase your odds for consistency tremendously. All right, so let's start out. Step number 1. Ask yourself, am I on the right side of the market? I know everyone going to a trade thinks they're on the right side of the market, but are you really? Because if you look back at your losses, that's basically the market telling you you're not in sync with what direction I want to go in. So in other words, you're not on the right side of the market. Every time you lose, you are on the wrong side of the market. You're thinking the market's going to do one thing that you're trading, and it does the opposite. So obviously, it stands to reason that the first thing you must do is get in line with whatever market, whatever time frame you're trading. Now, I know everyone and their sister thinks they have the perfect technique or indicator to tell them how to be on the right side of the market. But think of it, if most traders had the right technique or the right indicator, then why do 85 to 90% of all traders fail? It's because you're not on the right side of the market. I'm going to share with you what I believe is the simplest yet most powerful way to be on the right side of the market. Let's go back and look at our old friend Adobe here. Get used to this because we're going to be looking at this chart right now. But someone once again would look at this and say, well, I'm not really sure what the market's doing. It's going up, going down, then going back up again. Well, here's what we teach all of our students. Doesn't matter if you've been trading for 30 years or 30 minutes. The first thing you want to do is apply the 50-period simple moving average. Okay? Doesn't matter what time frame, what method you're trading, and then you ask yourself, where is price in relation to the 50-period simple moving average? Now, obviously, price is above. So if price is above, then the overall trend is up. That means if the overall trend is up, we want to be in sync with that trend, so we will only be a buyer. So as you see here, the majority of price bars are above. Now, all we need are roughly 5 or 6 bars to be above or to be below. But we would in no way think of selling this market. By selling, I mean going short. It doesn't mean selling a trade that you're already in. Whenever we say sell, we mean going short. So by no means will we ever think and tell our students to go short. You have to look at this from a buyer's perspective. Okay, so let's say you're a student of candlesticks. You say, okay, well, since I should look for buy setups, here's a bullish engulfing pattern. Okay, that's good enough. I mean, it doesn't really matter. Once again, the odds are in your favor that that'll work. So let's say that you want to use this as your setup, and you'll buy if it trades above that second bar, the engulfing bar. Okay, that's fair enough. That's a good plan to start out with. This leads us now to step number 2. Now, most traders think, well, okay, Steve, step number 2 means where am I going to get out with a profit, right? No, we have to think the opposite. Step number 2 is, where do I place my initial stop? Another way of saying this is, where do I get out if I'm wrong? Because remember, you could be wrong. Even though you are in sync with the market, you can still be wrong. So in our courses, we have upwards of 6 or 7 different ways to place your stop, depending on your risk parameters, depending on how much capital you have. I'm just going to share with you one of the most basic and generic ways to place a stop, and that's by using the most recent pivot low. Now, the way you determine that, if you're not familiar with, if you were to buy right here, if it traded up on the next bar and you went long, go backwards, and where would you find the most recent low? Well, that would be right here, right? A low is determined by a 3-bar pattern. You have a low here, followed by a low here, and then a higher low here. Kind of creates this kind of a V-type scenario. So this is the most recent low. You would place your stop just at or below that area, okay? Very generic, very simple. Once again, we have 6 or 7 different ways to place stops, depending on your risk parameters. This is just one of the simplest ways. You can apply any or all of our stops to still use these 4 steps. All right, this now brings us to step number 3, which is, now what is my profit target? Well, the reason why we want to determine what our stop placement is because it's going to help us to determine our profit target. For example, if we were to buy here, and if the trade did not go our way and we got stopped out with a loss, how many points would I lose? Not how many dollars, because everyone's going to have different share size. How many points would I lose? And so you determine from here to here would roughly be 11.25 points. Now, if you can stand that risk, if that's okay, if your account size or your risk parameters, if you can sleep at night, are okay with 11.25 points, then what you want to do is you want to double that amount. So what you want to do is add twice that amount to where you would be entering. And that would give you 22.5 points. And that determines your exit level, which would be right here. And now you know where to exit. So basically, we're just following good risk-reward ratio advice. We are making double the amount we would be risking. Very simple, once again, keeping things as simple as possible, but very consistent. This now leads us to step 4. How do I protect my profits? This probably, in my opinion, is the most important thing, because how many of you, I know I have in the past, but how many of you have had a good trade going your way on paper? You've got a nice profit, but it's on paper. And then one day you wake up and there's some news overnight, or one day you find out that the market just decided to go much, much against the way you want it to go. And what had been a nice paper profit is now turning into a rather large loss. It's probably the worst feeling in the world, right? Because you knew on paper you had a nice profit and now you've given it all away. Here's how to protect your profits. One of our plans that we have in our courses. We call it the 50% rule. So in other words, if we were to enter right here, if we traded above and we were to exit right here, where is the halfway point between entry and our exit point? Well, it's what we call our 50% level. So what we want to do is, if we see price come near or at that 50% level, what we're going to do is move our stop to unchanged. That means we are playing with the house money. We're not risking anything. And if by some chance we never reach this level and we never exit with a profit and price decides to turn around, well, at least we don't lose anything. We're just breaking even. All right. So we have all these things in place and we haven't even entered the trade yet, because now you're trading like a professional. A professional trader knows where he's getting in, where he's getting out if he's wrong, where he's getting out with a profit, where he's protecting his profits, even before the trader has entered into the market. This is the way professional traders trade. These are the 4 steps to consistency that can really help you no matter what method, what time frame, what market you trade. So let's watch the trade unfold. We still haven't entered the trade yet because we needed to trade at 224.50, and now it does. So now we're in the trade. We have our stop placement level, we've entered our order, we have our exit point, and we're just sitting back and watching, okay? Price is going towards that 50% level, and now it's intersected. So what do we do here? We cancel the stop and we move it up to unchanged, move it to our entry price. And so we're just playing with the house money. We have no risk at all. We're either going to have a nice profit of 22.5 points or we're going to break even. And that's the way you want to trade. So now we come to the point where the only thing left to do is to watch the trade unfold. You see, trading is really simple. There's no yelling on 2 phones. There's no looking at 20 multiple markets, different time frames. It's simple. You have this plan in place, and now you sit back and watch. I often tell traders, if you are trading correctly, it's very boring. It's like fishing. You simply go out in the boat, you cast your line, and you wait. It's no different. It shouldn't be screaming and yelling. It shouldn't be not being able to watch too many markets going on because everything's too complicated. That's more of a gambling mentality. But professional traders say that trading is really boring. If you have everything in place, it's extremely boring. So let's sit back and watch, okay? Because that's all there is left to do. You have all your orders in place. And it's going in our direction, kind of just hovering around that 50% level. But then ultimately, it does go in our direction. And in the next few bars, we've exited with a 22.5 point gain. See how simple that was? We didn't have to worry about economic reports coming out about, oh, what's going to happen with interest rates? Oh, what's going to happen with presidential economic reports? Makes no difference. We have our plan in place, so we don't care what comes out. We're either going to exit with a profit or we're going to break even. Let's look at another example, okay, for technicians. Let's look at this older chart of FSLR, all right? Looks like it's going lower, right? And what do we have here? If you're a technician, this is a bullish wedge, though. This is a very bullish pattern because this usually, if price closes above here on one of these next or following bars, usually means the beginning of a really strong, sustained uptrend. This is Technical Analysis 101. So you're excited. You say to yourself, well, if we close above that downtrending line, I'm going to buy. And look what happens. On the very next bar, you close above and you say, wow, I'm in sync with the market. I'm on the right side. I'm going to buy right there. Okay. But are you really in sync with the market? What's the first thing we tell our traders? Step 1. Am I on the right side of the market? Meaning, if you apply the 50-period moving average, you have to ask yourself, where is price in relation to the 50-period moving average? Well, it was originally above, but now we have 1, 2, 3, 4, 5, 6, 7, more than enough bars below to tell us that the overall trend is down. Are we going to be a buyer below the 50-period moving average? Absolutely not. Never buy below the 50-period moving average. Remember, the odds are against you. I'm not saying that there won't be some great buys below the 50-period moving average and some great selling short above the 50, but just like the slot machines in Las Vegas, every once in a while you'll have a great winner. The bells and lights and whistles will go off, but if you stay there long enough and do the same thing, you'll eventually give it all back. They're designed that way. It's no different when buying below the 50 and selling above. Every once in a while you'll get a great winner, but if you continue to do that, take it from someone who traded that way when I first started trading some 5 decades ago. You will eventually give it all back. So you never want to buy below the 50-period moving average. You want to put the odds in your favor. So the odds are in your favor not to buy. And guess what? Good thing you didn't, because it's not going in your direction. You would be sitting there 2 days later saying, wow, how come this pattern didn't work out? Because you're not on the right side of the market. We're not saying that that is not a good pattern, a bullish wedge, but you want to be buying above the 50, not below it. All right, so now that you understand that, and you say to yourself, okay, we're below the 50, so if I want to be in sync with the market, if I want to be on the right side, I have to look at this from a seller's point of view. Okay, so if I'm a technician, what selling opportunities are there? Well, there's some type of a base being made right here, maybe some type of false support. So, okay, I say to ourselves, if we break below that, then I will be a seller. I'll sell short. I'll go short the market, maybe buy some puts, but at least I'll be betting for this to go lower. Okay, that's a sound way to trade. Now you're in sync with the market. You're on the right side. This leads us to step 2, which is, now where do I place my initial stop? Once again, we have numerous stop levels for the different traders, but we'll just use the same generic one before. We'll go back and look at the most recent high, which is back here, okay? Now, a high means you have a 3-bar pattern. You have a high followed by a higher high and a lower high, kind of creates this kind of arrowhead approach. So if that's meets your needs, okay, I'll place my stop right here. So we know we're entering right here if we trade below, if we break that support, and we know we're placing our stop right here. But we haven't entered the trade yet. Now we go to the third step, which is, what is my profit target? Remember, this once again relies on where you place your stop. So you need to know where your stop is, because you want to have a good risk-reward ratio. In other words, if we entered here and the trade went against us and we got stopped out, what would we be risking in terms of points? Well, we'd be risking 8.20 points. Now, if we can take that risk amount with our share size or with our risk parameters, okay, all we want to do then is double that. That would be 16.40 points, but now we subtract it, because since we're going short, we subtract 16.40, and this will give us where we're going to cover. In other words, we want to make twice the amount we are risking. That is a good risk-reward ratio. It's very basic, very simple, okay? And that's our exit right there. So we would go short here, and we would exit with a nearly 16.5 point gain here if it worked out in our favor. And now this leads us to the fourth and, in my opinion, most important step, which is, how do I protect my profits? Step number 4. Okay? We apply the 50% rule. If we enter right here to go short and we cover right here, where's the half point distance? Well, it would be roughly around right here. Here's our 50% level. So once again, if price comes down to that level, it doesn't have to touch it, and because this is not written in stone, it can be anywhere near that. It can be intersecting it, above, below. It makes no difference. Just where we get close to that halfway level, then we're going to cancel this, stop, and move it back to where we entered. Okay? So let's watch the trade unfold. In 3 days, we actually touched that 50% level. So wow, we've got a nice profit, but it's on paper. Remember, anything can happen. We could all of a sudden go right back up and turn this nice paper profit into a loss. So what we want to do is cancel this stop and move it down to where I got short. Move the stop to our entry price. Now we are risking nothing. We're either going to break even and not lose anything, or we're going to have a nice 16.40 gain. So this brings us to the final thing, which is to basically do nothing and watch. Just watch the trade unfold. Remember, if you are trading correctly like a professional, it should be boring. It should be a lot of watching, really. Okay? So we haven't even seen if we've got a profit yet. We're just going to sit back and watch. We've moved our stop to unchanged. We've got our exit point right here. We've hit the 50% level. We just sit back and watch. And it's really going our direction. And in about a week, guess what? We touched there and we had a 16.40 gain. Okay? Now you see this in a lot of markets and a lot of time frames, but these are the 4 steps of trading consistency that I really feel can help you. You can start applying this right now to any method you have. Go back and look at your last 5 or 10 trades. If you had applied these 4 steps, I think you would have really been able to improve your odds for consistency. Let me share with you some more recent trades. Here's a 1-hour chart of the British pound, okay? Here's one of our strategies right here. I believe this is a strategy number 4 signal. We placed our stop below the most recent low, okay? Here's our 50% level. We went through that like a knife through butter and reached our exit point right here for a quick gain, roughly about 5 hours of 95 pips. That's nearly $1,000 per unit. And look how you exited nearly at the short-term high right there before it started to go lower. Here's another example. This one was in SMCI. This just happened just last week. Okay, we had a buy signal right here using one of our strategies. I believe it's strategy number 6. We placed our stop just below the low. That's where this particular stop placement was. So we measured the range. If we would have entered here and been stopped out, we doubled it. And here's our exit point. And in less than 4 days, we had a nice 6-point gain. That's how simple this is. It's so easy. Here's a chart in NVIDIA. This just happened this past month as well. Another buy signal was generated using the most recent low as the stop. Okay, we just went back 1 bar. We measure from entry to stop, and we double that. And here's our exit right here. It's a nice 14-point gain. You see how we got right to the 50% level and kind of paused before we got right back up to the exit. And then I should say an older example here in AB&B. This time, as you can see, sometimes you will get some really nice trades like this. Here was a buy signal. We placed our stop just below. We doubled. Here was our exit on the opening, a gap opening 2 days later. Didn't even have to worry about the 50% level. And look what happened. After we had a 2-to-1 risk-reward ratio, price went all the way down. So had we not exited, we would have given back all our profits. So you see, this can help you in any market and any time frame. Now, I want to tell you about a great offer. If you like these really consistent tips I just shared with you, these really nice edges, how would you like to have at least maybe 5, 6, maybe a dozen more? Well, here's the great offer we have for you today. It's called our Trading Floor Edges course. This is a course, it's a 10-video course actually, which includes over 48 years of trading experience, tips, techniques, and edges that I've accumulated in my 48 years that are going to be yours with this great, great offer. More high probability trading edges like the ones I just shared with you today. 2 techniques that will elevate your trading. How to be in sync with the overall trend, which is what I shared with you today, but 4 different ways to do that. 3 steps to a successful trade. How to fine-tune your entries. How to take your exits to the next level. But I think this is the most important thing that we have here on the Trading Floor Edges course. It's what we call our superior candlestick trading edge. Let me share with you what I mean here. I know most of you have either dabbled with candlestick trading or you are currently, but you're probably not seeing the type of trading results you were promised, right? I know I wasn't when I first learned about candlesticks some 4 decades ago on the trading floor. Candlestick trading techniques are what we call reversal patterns. In other words, you're looking for a trend to be established, and then the pattern is usually a reversal pattern, telling you that that trend is going to be reversing. And so they're like warning signs for you to get ready to either change with the trend or to get out of the one you're currently in. For example, in this chart of WDAY, okay, workday, we see that obviously the trend is up. So if you're a candlestick trader, you're looking for some type of reversal. And what do we have here? we have one of the most prominent reversal patterns. It's a bearish engulfing pattern. So obviously this would tell you that it's a traditional way of trading candlesticks. The trend has been going up, and this is telling you and warning you that the trend is most likely to stop. So if you use this in the traditional sense, you would most likely sell right here. And then look what happened. Does this look familiar, right? The very next day it gapped up, and you would have lost a lot of money on that, or turned into a long-term investor or in this short position. But what if I told you that you would have not have been selling here? In fact, just days before that, this new candlestick technique would have generated a buy signal, and you could have potentially captured upwards of 35 points in the next week. So this is what we're going to be sharing with you in the course, our Superior Candlestick Trading Edge. You'll learn all the rules, lots of examples, and it's yours to keep. So let's break it down. You're going to get all these edges along with a superior candlestick trading technique. Remember, you can apply all of these edges, these dozens of edges, to virtually any market and any time frame in this 10-video course. Now, normally this costs close to $1,000. That's how much it's jam-packed with information. Here's what we're going to do. We're going to discount it for a limited time only, down to only $19. This is a fantastic discounted price. Nearly 5 decades of tips and techniques that I've accumulated in that time are going to be yours for only $19. But this is for a very limited time only. So you have to take advantage of this quickly, or else it'll go back to nearly $1,000 again. But we're not going to stop there. We're also going to throw in an extra bonus. If you decide to become a member of the course, the Trading Edges course, on this limited time offer, we'll also include a 50% discount to any other product we sell, any other strategy, any other indicator. It could be a $5,000 product. You'll get 50% off. It makes no difference. So this is a great promotion to have. It's for a limited time only. If you're one of our students, you've been around for a long time, you know that our stuff is very consistent. It really helps. If you've been thinking about purchasing another strategy, here's a great way to get a 50% discount. If you're new to my teaching and new to our methods, this is a great way to become familiar with us at a very low discounted price. You owe it to yourself to take your trading to the next level. If you've been struggling, if you're having difficulty with your trading, trust me, I know what that's like. I didn't make any money for the first year or two I was trading, and I was on the trading floor. I had access to privileged information. I had high-speed computers at the time. No one else had a personal computer. They hadn't even been invented yet. So we had access to this, and I still couldn't make a dime because I was following the wrong things. These are all the things that turn my trading around, and I think they can turn your trading around as well. Okay, here's how to take advantage of this great offer. Contact my sister site, Pro Trader Strategies. They're in charge of all the discount pricing. They're also in charge of all the tech support. They can answer any question you may have. They can take your order over the phone. I would highly recommend, if you're interested, giving them a call at area code 310-598-6677. They have trading consultants manning the phones right now. They'd be more than happy to take your order over the phone or answer any question about the 50% discount and any other method that you may be interested in. Now, that link you see at the very bottom is the link that will take you to the info page for this special offer. You can also sign up there online if you'd like, but it's not a live link. I believe if you go to the chat box, let me open that up. Yeah, they just posted a live link in the chat box. So you can click that on, and that will take you to that page, and so you won't have to copy and paste that. So we have a few minutes left. I'm going to leave this information up here for you. If you have any questions concerning what I taught you today, now's the time to ask. Just go to the question and answer box or to your chat box, and I'll answer them as quickly as possible. Someone's asking, can this edge you taught today, can it be applied to intraday? Yes, it can. It makes absolutely no difference. So if you trade 5-minute charts of stocks, or if you trade E-mini futures like I do, it makes absolutely no difference. You can apply any method. It doesn't have to be one of mine. It can be a method from another educator. It can be something you made up. It makes no difference. But if you use that 50-period moving average, and then you determine if you're on the right side of the market, I think that just that edge alone will increase your odds for consistency tremendously. And I always say this in my webinars: if you don't believe me how powerful using the 50-period moving average is, Go back and look at your last 10 or 20 trades. I can almost guarantee that you had losses because you were buying below the 50 and you were selling above. And once again, every once in a while, you'll get a great buy signal below the 50 that is the bottom of the market, or a great sell short signal above the 50 that is the top of the market. But like the slot machines in Las Vegas, you will get a winner every once in a while. It will give you this false sense of security that you're doing well. But if you stay at that slot machine long enough, you're going to give it all back. They're designed that way. And it's no different when you are buying below the 50 and selling short above the 50. It's designed for you ultimately to give it all back. Once again, if you don't believe me, go back and do the research. Go back and look at your losing trades. Most likely you were out of sync with that simple rule. So if you think that rule could help you alone, there are so many more edges just as powerful in this 10 video course. Someone's asking, is this video course ours to keep or a limited time only? Oh no, the offer is for a limited time only. It's yours to keep, for as long as you want. And you can go back and use it as a resource and go back and watch the videos over and over, certain aspects of the video. This is not something that will disintegrate in 3 months and you have to give it back. It's yours. It's yours to keep forever, as long as you want. And you can, as I said, go back and review these whenever you like as a refresher course, okay? But the only thing that isn't going to be forever is this $19 price. It will revert back to roughly $1,000, I would say, in the next few days or so. So if you're really interested, just give Pro Trader Strategies a call. They can answer any more questions you may have. If you're a student of ours already, I see a lot of people in the class here today that are current students of mine. I want to thank you again. And if you've been thinking about getting another method or another indicator that we have, this is a great time to do that because you'll get a 50% discount on any other method that we have out there, okay? So as we close now, remember, give Pro Trader Strategies a call. There's absolutely no obligation, even for a small $19 offer like this. There's no obligation. Just give them a call at 310-598-6677. They'd be happy to work with you or answer any question you may have, okay? Now, as we close now, after this early bird session we usually have our classes on Wednesday at 10 o'clock Pacific time. I had to do it early today because of previous engagement, so I hope it didn't mess up anyone's time frame. But this has been recorded, so if you happen to come in late or if you miss it, don't worry. Each and every one of you will get a link to this recording. You can watch it at your own leisure, okay? But please do not sit on this offer. Once again, I can't stress enough, it will go back to close to $1,000 in the following days. As we close and take one last look at our disclaimer, I just want to say thanks for attending today. Thanks for coming at this early time. I hope you learned something today and use these 4 steps that really will increase your odds for consistency. But most especially, I look forward to having you students of mine in this 10 video course, this Trading Edges course. Thank you so much for attending. I wish you all the best of luck and look forward to seeing you in class. Bye-bye.